Welcome to the class again, and in this we are going to talk about national income aggregates. And these are divided into two parts. One is the domestic aggregates and the other is the national aggregates. In this we're going to talk about what income is generated in the domestic territory of a country. If we talk about that is domestic product, and everything which is within the ambit of national economy. That means income generated inside as well as outside the country by residents, non-residents, and all of that we are going to study in what is known as national product. So national aggregates consist of, again, let me tell you, domestic product and the national product aggregates. And in the domestic product aggregates, we have what is known as, say, GDP-MP, gross domestic product at market price. Then we have what is net domestic product at market price and net domestic product at factor cost, which is nothing but domestic income. And to all of these, if we add the abbreviation, that is NFIA, that is net factor income from abroad, if we add that component to these domestic aggregates, we get the equivalent of a national product. For example, if to GDP-MP, if we add NFIA, so what does it become? G will remain gross. Instead of domestic product, we'll have national product and market price, etc. So you just listen to this or go through this. Then it'll help us to understand better. So looking at this, we have, and in this it's very important that you have a good understanding of the residents, what are residents, and the domestic territory of a country to understand this concept. It is very important. So let's take up the domestic aggregates. So what are they? Domestic aggregates refer to a group of statistical measures of the value of production activity being carried out by production units located within the economic territory of a country. So they are located in the economic territory of a country, irrespective of whether carried out by the residents or non-residents. So here there are three main measures that we'll be doing. That is, one is gross domestic product at market price, which means, so we'll take each one, and second is net domestic product at market price, and the last one is net domestic product at factor cost. Now if you see the domestic, and you can see the national too, and in that if we add the component of net factor income from abroad, then you get these components which will change into national products. For example, if you're doing, let's take the first one, GDP at MP, that is gross domestic product at market price. If you add up NFIA, net factor income from abroad, what you get is gross national product at market price. So from domestic it goes to national. So then you have what is known as net domestic product at market price. So in this, if you add up the net factor income from abroad component, the domestic product changes into national product. And again, in the net domestic product at factor cost, which in short means the domestic income, if you add up the component of net factor income from abroad, what you get is net national product at factor cost, which is another name for national income. So basically all of that. And let me just tell you, so again, what is national product then? So national product includes production activities of residents, irrespective of whether performed within the economic territory or outside it. So here we are talking about the territory, inside or outside the territory. And there we were talking about residents. In the domestic product, if you understand this, it becomes very simple. In domestic product, just remember that it is all the Domestic product includes all production activity of all the production units located in the economic territory, irrespective whether carried out by residents or non-residents. And here, in national product includes production activities of residents, irrespective whether performed within the economic territory or outside it. So that's very important. So here, let's just take the first one, gross domestic product at market price. What does it mean? See, the term domestic implies belonging to the economic territory, number one. Product refers to contribution of production. Domestic product thus means value of production carried out in the economic territory. Now, the subscript gross, what does it indicate? It indicates that domestic product is gross, that is undiminished by deduction of consumption of fixed capital. That means there is an element of depreciation added. The value of depreciation is there in this. It means just that. Then the subscript market price. What does it signify? That the value of the production is calculated by multiplying by the prices which buyers paid and not the price which production units actually receive. That means the price actually received by the production units equal market price less indirect tax paid plus subsidies received. To sum up, so market price signifies that the value of domestic product is undiminished by net indirect taxes. That means the net indirect taxes are included. The value of net indirect taxes are included in this particular aggregate. So, in short, GDP-MP is the value of contribution to production by all the production units located within the economic territory of a country, undiminished by consumption of fixed capital and indirect tax and without adding subsidies. So let's go on to the second one, that is net domestic product at market price. So simply I'll just say it will have everything what we just studied or which I just talked about. The only thing that we'll notice is that the element of depreciation is no more there. It has been taken out. It has been deducted. The value of depreciation is not there. That's why it becomes net. So it's not gross domestic product, it's net domestic product. So gross domestic product, let's take how did we come to NDP-MP? Diminished by consumption of fixed capital is NDP-MP. Now what is consumption of fixed capital, which we've already done in detail earlier? It means depreciation, consumption of fixed capital. So NDP indicates the net availability of final products because the availability is reduced due to loss of final products caused by the consumption of fixed capital. So NDP sort of gives us a more realistic picture of an economy. We arrive at NDP by deducting consumption of fixed capital from GDP-MP. So if we see NDP-MP, how do we arrive? See, you take the previous one, GDP-MP. From there, if we minus depreciation, we come to NDP-MP. Okay. So to define it, how do we define it? It is NDP-MP is the value of contribution of production by all the production units located in the economic territory of a country, diminished by consumption of fixed capital, but undiminished by indirect taxes and without adding subsidies. That means the net indirect taxes are, the value of net indirect taxes there, but the value of depreciation is not there. That means the value of consumption of fixed capital is not there. That's why it becomes NDP-MP. Now we come to the next one, net domestic product at factor cost. That is NDP-FC. Now, in this again, what they've done is that there is no value of depreciation in this. That has been taken out. And also the market price of a good includes indirect tax levied on goods, uh, but does not include the subsidy, if any, paid by the government. The indirect tax paid by the buyer is deducted because it ultimately goes to the government and not to the production units. So subsidy is the opposite of indirect tax. It is paid by the government to production units and is over and above the market price. This adds to the value of contribution of production units. Therefore, it is added to GNP MP, what we did. But in this, what happens is that we do not take this. We do not evaluate net indirect tax. So we minus that element, that value, and what we get is net domestic product at factor cost. So what is factor cost? Now factor cost is the factor payments made by production units to the factor owners. Therefore, factor cost and factor incomes mean the same thing. So now you can just see that gross, remember we did gross and net, the difference is depreciation. Talking about market price and factor cost, the difference is net indirect taxes. So we've done that. And the other thing that we are going to do here is we've done gross and net. From gross, if you see, we minused depreciation. If you minus depreciation, you get what is known as net. And from market price, if you minus net indirect tax, you get what is known as factor cost. So now what do we do? Now what we will do is, to get the national product from DP to NP, what do? We add up net factor income from abroad. So in each of these aggregates, we are going to add up an element of what is known as net factor income from abroad. So that'll help us understand, or we'll finish off with this. So this is what it is. Okay. So what are national aggregates? Let's just now talk about national aggregate. It is a measure of the contribution of residents of a country to production, both inside and outside the economic territory of the country. So, like I just said in the beginning, that national product includes production activities of resident irrespective of whether performed within the economic territory or outside it. So this is what it is. So